I know they were kind of quizzing in my topics.
Be sure and sign in.
I give a litany of choices, and they were like, "You just decide." And I said, "When I'm budgeting, we already did budgeting." I'm like, "Okay, we'll move on to basic investment concepts." So I think what you'll get out of this presentation is really just understanding all the terms you hear on the news. What does all this stuff really mean? I really do think you'll get, these are kind of basics of what the investment concepts are out there in the industry. So when you leave, you'll know more things about what a bull or a bear is, and what a large cap stock really is, and what's a stock or a bond. I'm going to go through those kind of things, which is just good basic information. So that's kind of the plan for today. I think most of you know I handle the 403B claim here for Tri-County. And so if you're not participating, you should. It's a great, great benefit. There's matching contributions for the plan. It's a great way for you to save money, pre-tax for your retirement. So again, you might visit with the HR staff here and explore that option. I'm usually out probably twice a year. Once per semester is traditionally what we've been doing. I'm up in Bartlesville monthly, so you can always feel free. I'll get you some cards up front. You can catch me. I've already met with some staff this morning, and I've got a few more meetings after this with people here at Tri-County. But again, don't forget about this benefit. It's a way for you to take care of you. Okay? Well, with that, let's get into basic investment concepts. See what we got here. I have a couple disclaimer slides, but we'll get past that. You know, we're going to talk about the different types of investment. What is a stock? What's a bond? What's a mutual fund? I get those questions a lot, so I think it'll help you. We'll talk about some market trends and investment concepts. So that kind of is the whole agenda for our time together. We'll start with the different types of investments. What is a stock? People, I mean, really, at the end of the day, when you own a stock, what is it really? What do you own? So let's talk about that a little bit. So, stock actually represents owning the company. So if you own a share of Apple Computer stock, you are one of the millions of shareholders plus who actually owns Apple Computer. Does that mean you can just walk in and say, "Where's my paycheck?" No. You're an owner. You're an investor. At some point, someone owned that company privately. They sold stock to raise money, so they gave up part of their ownership to the public who bought those shares and in theory are owners. So why do you buy a stock? What are the investments? How do you make money when you own a stock? Well, there's two different ways. One is if they pay a dividend, all right? The other is if the price goes up. So Apple Computer, good example, they're really not paying a dividend right now, but the stock's going up, right? So how do you make your money in Apple Computer? You bought it at $100, it's gone up over to $600, so you've made a lot of money owning the stock. But consequently, let's say I own AT&T stock. AT&T stock trades at about $31 a share. It's paying a 5% dividend roughly right now. So I would actually get 5% of $31, about $1.50. They're paying that out in an annual dividend in cash. So I can either choose to reinvest that and buy more shares, or I can have them mail me a check. So how do I get value out of a company? Well, I want to see how they're going to make me money as an owner, right? So those are really the two basic ways. Hang on, upstage. Go ahead and go over to the computer. So stocks can really be issued in three different types. And this kind of even follows the way they're set up in the 403B plan here at Tri-County. Large cap stocks, medium cap stocks, and small cap stocks. So I want to talk about all those, so you know what those are here in a few minutes. So let's start with what does all this mean? What does large cap, small cap, mid cap really mean? So it really is representing the market capitalization of the stock. So it's the current share price times the number of shares outstanding. How much is the total value of the stock of the company? So large cap stocks, if you never knew before, are worth over $10 billion. That's our parameter. And that's why you have Big Tree, right? Makes sense. Big Tree, large cap stock. So mid cap, it's not a seedling, but it's a little baby tree, I would say. Between $2 and $10 billion. And then you've got the small caps of those new companies, $300 million to $2 billion is their market capitalization. Keep in mind, it's only based, when you hear small cap, mid cap, it's based on the total value of the outstanding shares. The current share price times the number of outstanding shares. Okay? It's not based on their performance, just their size, relative size. So that's probably something you didn't know. People have done this and go, what are these ranges? When I see on there JP Morgan small cap value, what does that really mean? Well, now you can tell me it's a stock between $300 million and $2 billion. You probably don't even recognize the companies. If you saw their names, you might go, I don't know many of these names because they're up and coming. They're not as mainstream yet. Okay? The other question I get a lot about is, what are all these different indexes and what do they mean? So let's spend a few minutes just going through this a little bit, kind of understand how they go. And this is going to go from, the top is the narrow to broad. So when you hear the Dow Jones Industrial, that's what they usually quote on the news at night. That's the 30 largest stocks in the United States, roughly. That's what the Dow's got industry stocks, those top 30. It's only 30 stocks. So don't base your whole life on the top 30 stocks, is what I would suggest, even though that's the measure we will work off of. The Dow is around $13,100 today, right? But keep in mind, in 2008, it dropped to $6,800. So my argument for you would be, hey, it did drop and that was painful, but if you put in money at the low, you've more than doubled your money coming back up, right? Or roughly in that range. So keep that in mind too. The Standard & Poor's 500 is the 500 largest U.S. companies, right? When we say U.S. anymore, but half their earnings are from overseas, so U.S., yes, but it's almost an international flair these days. Then Russell's got two indexes that they evaluate large cap stocks on. They've got the Russell 1000 Growth Index and the Russell 1000 Value Index, and I'll talk about those in a few minutes. Then the mid-cap index is the 400 largest mid-cap stocks, between that $2 billion and $10 billion again. Small cap index, the S&P's got that as well. The Russell 2000 is just the largest 2,000, and the Wilshire 5000 is the largest 5,000 stocks. So don't spend a lot of time on these. I'm just trying to give you a quick overview of what they are. So what affects a stock's price? People want to know that a lot. Like sometimes people will call me and say, I've had a lot of these calls lately, I want to buy Facebook stock. IPO is going to come out pretty soon. Supposedly they filed for it. It's not been issued yet. They want to own it because they just feel so great about Facebook. Let's talk about that. We'll kind of look at it. We even use Apple Computer, same example. It's already a stock, of course. So what affects it? Definitely the company performance, industry, things that are going on, economic, social, political issues, supply and demand, all those things affect the stock's price. Let's also look real quickly at the stock market performance over time. And this is 1980 to 2010, so the last 30 years. If you can look at the slide, you can kind of see the stock market's averaged 11.36% a year. And you can see most years was up. Obviously, we've had some down years. We all remember this one, and we definitely remember this one. This was 2008, right? It goes up and it goes down. I tell people 8 out of 10 years you're going to make money in the stock market. There'll be 2 years you probably will not. And I also tell them, let's just keep the goal in mind. If I sit where I sit today, I'm not retiring for 30 years, roughly, right? 25, 30 years based on my age. If it goes down tomorrow, I'm not excited about it, but it doesn't really affect me. I'm looking for the end game. It's kind of like if you guys are sitting there making budget decisions for Tri-County based on this year's budget versus the 5-year plan, you got to look and see how it's all going to flow out. It may take time to develop. It doesn't always happen in 1 quarter or 1 semester. I told you we talk about what's a growth stock versus what's a value, so let's spend a few minutes on that. So we hear that a lot, and we'll attach them to each one of those measures: small cap, medium, and large. Large growth, large value. Small growth, small value. So on both sides, so this will apply to all. So typically a growth stock is one characterized by revenues or earnings are growing faster than the average company, so they got a fast growth rate. Makes sense. They're expected to continue to show high levels of profit or growth. Think about Apple Computer here, guys, all the way. They're characterized by a high price to earnings ratio, PE, and below average dividends. So what does that mean? They're growing really fast. They're adding a lot of new stores, a lot of new products. Their sales are really probably increasing at well over 10% a year. Really fast growth rates. They're reinvesting. They're not paying a dividend probably, or little to none. Why? Because they're reinvesting all the company's profits back into the company to continue to expand and sell. So that kind of makes sense. Think about Apple Computer. Are they paying a dividend? No. What are they doing? They're reinvesting all that money back in research and development for the next iPad, for the next Apple TV, all these things they're working on. That's the phase they're in right now. Okay? But let's contrast that with a value stock. Value stocks are deemed to be undervalued in price. They could eventually have their worth recognized by the market. They're characterized by low price to earnings ratios, below average growth rate forecasts, and above average dividends. So what are they doing? Think about Walmart. How many more stores can Walmart add? My gosh, they've got thousands. I don't even know how many stores Walmart's got, but it's not like they're adding 10% more stores every year anymore. They were there. Now they've become more of a value shop. Now they've been paying a dividend anyways, but now they're focused on just, think about a company that doesn't add anything. Let's say Walmart didn't add another store. Well, they still make their margin. They still make money, just profit off what they're doing day to day. So they're paying a dividend based on that back to shareholders, right? So when you think about large value, think about the big name companies, GE, Johnson & Johnson, Coca-Cola. We call them blue chip stocks, these big names. Those are the kind of stocks that I would look at and think those are the value stocks. They're not growing at these rapid rates anymore, but they're still these big players. They're very dependable, great to buy and invest in, of course, right? So that's growth versus value. Growth stocks are growing fast and reinvesting in themselves. Value stocks are big and large and paying partly a dividend and growing at the same time. Okay? What's a bond? And people ask me that one as well. We went over stock as ownership in the company. How about a bond? Bonds are kind of like an IOU. They're generally issued by a government or a corporation, and they describe the terms of the loans. We'll get into that a little bit. They potentially generate money for investors through interest payments and rising in value. Issued by many entities, and they come in a variety of qualities and maturities. So when you buy a bond, you're actually kind of like a creditor of that institution, right? So think about, like, the big one people used to buy years ago with the Oklahoma Turnpike Authority bonds or the Grand River Dam Authority bonds. Those are municipal, those are local bonds in the state of Oklahoma. They used to pay about 5 or 6% interest. They pay like 2 now, so not nearly what they once did. So you give them your money. Bonds are issued in values of $1,000, right? And they have some terms. So let's use an example here. Let's say it's a bond. It's a 5-year bond at 5%. So what does that mean? I give them $1,000. They're going to hold it for 5 years. At the end of the 5 years, they're going to give me my $1,000 back. But each year, they're going to give me a 5% dividend. So $50 a year. So each year, I'll get the $50. And in the last year, I'll get my $1,000 plus my $50. So that's what a bond's kind of like. You become the bank. You're the opposite. You don't own the company. You're not an owner. You're a creditor. Okay? Why do we think that's safer? Because they've already budgeted to have the bond payments, and you're going to get that as income, of course. That's kind of the plan. So obviously a lot of retirees generally have more than 50% of their money in bonds because they can count on that as to generate the income, the cash flow they need to survive. The problem these days is those rates are so low, they're sitting there going, what else do I do? They have to reach into some dividend income as well and take a little bit more risk than they typically would like in some examples. So let's talk about the types of bonds. I kind of gave you an example of a government bond. So they're issued, treasuries. You hear about those in the news a lot. There are agencies and there's municipals, and then there's corporate bonds. Corporates are issued by companies, of course, investment grade or junk, and we'll go over those in a second. A lot of you probably have got, the old days, grandparents used to give the kids bonds. I don't know if they still do or triple.
I have tons of those.
You got tons of those bonds? Okay.
Yes, I don't know what to do.
Well, they're worth something.
I have a 12-year-old. He's gotten one every Christmas and every birthday.
Yeah.
So he has 24. And then I have a 10-year-old. He does the same thing.
Yeah, so.
You can take over. Yeah, they're all 10.
You tell me how
Yeah,
to
I got one about
money
$5.
off my bonds. Yeah.
So, where you can go to check out your bonds, by the way, is ussatingsbond.org. I think it's the website, ussatingsbonds.gov, and you can put in the issues dates from your bonds and they'll compute the prices. Used to be you could go to the banks and the banks would do it, but they don't want to do it as often anymore. They're going to refer you to the internet now, more often than not. So ussatingsbonds.gov, and the bonds are all based on when they were issued, the rates and
do
such.
they cap out?
No, they never cap out. They go through their normal maturity, and they've kind of got a bonus period. Yep. So it's worth checking. My problem with these old bonds is they're tedious. What do you do with them? How does she sell? She's got to go to the internet. She's got to figure out where to go redeem them. It's not like she bought them through an investment account and can easily redeem them through someone like me just by calling me. So that makes it a little harder. But they still have value. Hey, my kids have got them too. I've just got them in a safe deposit box for them. And I haven't pulled them out since they were given to them at birth, pretty much, right? Bonds are rated, so the amount of interest they're going to pay is based on their rating. If they're a high credit quality and really considered a safe company, high chance and likelihood they're going to be able to pay you off consistently, they're going to get a higher rating. So you hear about bond ratings. I don't know if you all know about that or track some of that. You might. So let's talk about that. Generally, the two main bond rating agencies are Moody's and Standard & Poor's, right? AAA is the highest credit rating. That means they've got the best looking books and everything else. See, the big thing about the U.S. government, we were dropped down to AA. Did y'all remember that? And it's because they're saying, hey, based on your current budget, and honestly, looking at it, I can't argue with that decision, right? I mean, it's not, the government's kind of a mess, of course. But it made some U.S. companies better investments than the U.S. government, which is a really weird synergy thing to have happen. It's not a usual thing. So then you go down to AA's are high quality. Single A's are favorable. Triple B is medium quality. Then when you get to single B or double B, you start getting into losing your high credit quality or investment grade status. But what happens is, the lower you go down that list, the higher the interest goes. Okay? Why? Because you're taking more of a risk with a company that may or may not be able to totally pay you out with cash flow or expectations on the future. Now, you would never buy a G bond. Obviously, they're in default. You wouldn't buy it. But you know, people do. Who would buy that? An investor. If I could go buy some bond at 10 cents on the dollar, I may go do that and try to hope it comes back. I mean, it's not something you and I are going to do, but that's when you hear those kind of things. If you ever watch the news and you hear, well, the bonds are going to go at 7 cents on the dollar, and they're still going to try to redeem something on those over time if things get better. Usually it's not me and you doing that, but it does happen. You talk about like Greek bonds. If you've been listening to the news, they'll talk about the current Greek government bondholders are only getting like 10 cents. Okay? That's what I'm kind of getting at. But someone may go ahead and sell it for 8 cents because they know they're going to get 8 today versus the 10, who knows, you know what I mean? And that person may hold on hoping there's value in those in the future when things do better in Greece. So those are the kind of the bond ratings. And you know, there are, inside the 403B, we've got investment grade bond funds, we've got corporate bond funds, government bond funds, and high yield bond funds. High yield bond funds pay interest of about 7%, guys. And that's about the interest rate inside the high yield bond funds that are in your plan. Now people look at that and go, well, that sounds great, I'd love 7% interest. Keep in mind, their credit rating of those bonds, those companies they're investing in is not that high. So there's a lot of risk to their industry and changes that could occur where they possibly may not be able to pay you out. Hadn't been the case in any of the funds in our plans. We've had no defaults, I should tell you that. But that's the point, it's a risk you take. So for example, in 2008, high yield bonds were paying like 15% interest. So people were loving to go buy the income. The risk, the fear put them there. But they usually pay about 7%, just so you know. But corporate bonds are paying about 3% right now, just to give you an idea. The average corporate bond rate is about 3% today. What affects the change of a bond price? So this is real exciting stuff. You're learning some things, right? So changes in the fundamentals of the issuer and changes in interest rates. So obviously that's where it's kind of bumping up against possible changes in interest rates. This will be a good conversation to have. This slide's pretty busy, so let me just walk up to it because I think once I walk you through it, it'll make a lot more sense. Okay. Basically what it's saying is, if interest rates go up, and I own a bond today at 3%, but a new bond now will pay 3.5%. My current bond at 3% just dropped in value. Why? Because someone could buy a new one and get 3.5%. Does that make sense? So the new bond is $1,000. The old bond is now probably going to drop in price to more like it's going to drop in value like $800. Why? Because someone buying it today is not going to pay $1,000 for one that would be, they could buy the new one for $1,000 that would pay a higher rate. So now when that changes, it does mature back to $1,000 if you hold it to the maturity of the bond. So don't get freaked out. So a lot of people in 2008, the bond prices, depending which bond you own, people are just selling them even though they shouldn't have. They should have been buying them. People in fear would call and just say, sell everything. What they really meant was sell some of the higher risk stocks. They should not, probably never mess with the bonds, but out of fear, people sold good bonds too, which drove the prices down, right? The rates went up. That was a good thing. So it's it works kind of the opposite. Consequently, if I've got a bond that's paying 3% and interest rates go down, people are going to pay me a premium for my bond. They may want to pay me $1,200 while that bond's not matured in the open market to buy it, right? Just through your investment account. They would pay me a premium for my bond. Why? Because they want to buy the income. People want to buy the income typically because they know they're going to get that income stream. Does that make sense? Because the new bond's going to issue at 2.5%, let's say, versus the other. That's what that slide says in a nutshell. I'm sorry, I just think it's easier to talk through it than just say that. I didn't use those numbers, of course, that may confuse you. All right, so we talked about stocks and bonds. Now let's talk about mutual funds. So mutual funds are collections of stocks and bonds or other equities, and they're managed by a professional investment company, right? So professionals are supposed to be watching this, making the calls for you. They have administrative investment management fees, so they charge a fee to do that generally, right, inside the fund. They have a stated investment objective and policy, and they come in a wide variety of types. So let's flip to the next slide, it'll kind of show us some of them. For example, there are fixed income or bond funds, government, corporate high yields, foreign, municipal. I'll kind of go over that a little bit today. There are equity funds, which are stock, aggressive growth and income. There could be a large cap value fund, which we know now is $10 billion or greater, and generally is paying a dividend. There are large growth funds that are worth over $10 billion that are growing at a faster than 10% rate, probably not paying a dividend. That's kind of how you figure out what classifications these things fit into. There are sector funds. A sector fund would be for someone who calls and said, I just want to buy natural resources, or I just want to invest in real estate, or I just want to invest in gold or precious metals. Those are sector funds, right? They're riskier because it's one slice of the pie, one real narrowed-in piece of the puzzle. There are money market funds. Money markets are like savings accounts, right? Short-term interest rate accounts. There's combinations of those, which we would use called balanced funds, which are usually half stock and half bond. Asset allocation or target date funds. I mean, a lot of you are invested in these target date funds in our plan here at Tri-County, like the target date 2015, 2025. Those are funds that we blend in. We pick 18 to 20 different mutual funds that are appropriate for someone who's in that slice of age. So it's professionally managed, diversified. Someone's watching it for your rebalancing. Okay? If you go through and pick your own model, it's really on you to say, hey, this is my model and I'm managing it. Okay? So the nice thing about a mutual fund is, say you walked in my office and you had $100, and you said, Greg, I'd really like to buy stock in British Petroleum, right, BP. Well, you take on all the risk of British Petroleum in that one investment. Maybe great, maybe not. But what if you could come to my office with $100 and say, I want to buy a large cap value mutual fund? You just invested in 100 stocks with your $100 versus just the one stock by buying British Petroleum. So it lets you get in the game of a fully diversified portfolio, and at least in that area, with your small amount of money, and then the professionals are watching it. Okay? That's kind of the example of why we like mutual funds, of course. And the other thing is, if you bought a bunch of individual stocks in your 401k or 403b, that's a lot of risk. These things go up and down, as you see. It's a lot better when professionals are making the calls. That's why generally almost every retirement plan requires money in mutual funds, and they do not allow stocks purchased individually. You know, there's different styles of funds and how they manage money. I don't spend much time on this slide. It's kind of busy, kind of what that's getting into. Let's get into market trends and investment concepts a little bit more. We've covered the stocks, bonds, and mutual funds, and now let's talk about these. So, you know, generally people invest their money, they're conservative, they're moderately conservative, they're moderate. These are some examples of those portfolios. So, for example, a conservative portfolio is you're going to have 80% of their money in fixed accounts or fixed income. All right? A moderate portfolio is going to be about half and half stocks, half bonds. A moderately aggressive is only going to be about 20% in stock in bonds, 80% in stocks. And aggressive, you can see, is about 90% in stocks, 10% in bonds. These are just general flares. At the ING website for your retirement plan, you can actually go through and answer some questions and figure out which model's right for you, actually, which is kind of neat. So you might take that as an action step when you leave if you want to play with that. So being diversified is important. Why? Sometimes people will say, like yesterday, I had a client come in and I said, you know, I'm going to put 10% of your money in international stocks. Why would you do that? Aren't they down right now? Wait, yes, they are. But that's what we're supposed to do. We buy low, we sell high. But emotion doesn't want us to do that. Emotion says, why would I buy that? Why would I want to buy anything in Europe? Well, because it's a 25% discount from a year ago. That's why. You would have said the same thing in 2008 about the United States, and those monies have doubled. So being diversified makes a lot of sense. Rebalancing makes a lot of sense. Okay? Getting back to your original mix. I know we fall in love with our stocks. I'm actually starting to sell Apple Computer for clients right now. It's gone from $100 to $615 in 2 years. I still love the company, but it's gone so great. Sometimes you've got to trim the sales back so you're not overexposed to it going down. That's kind of my point. They are so tied to the next great technology and staying the leader in that. If they ever get a blip or a miss on that, that's what's going to happen. The stock's going to fall fast. So being diversified is very important. Owning these different layers of things that you may not think makes much sense, right? So what's portfolio diversification? When you have two investments that go parallel, the returns move up and down at the same rate, right? So the risk was not reduced in the portfolio because it has no diversification. If I have two stocks that do the exact same thing, they both go up at the same time, they both go down at the same time, my total outcome, I'll have no defensive when they go down, right? You want to have a blend in there. So that's not a diversified portfolio. You know, when there's some similarity, movement among the returns between two investments, risk can be reduced when you combine them. So if there's some, they're not totally parallel, there's some, you do reduce your risk a little bit. But the whole goal is, when two investments move in opposite directions, the strongest diversification effect will be produced. So it greatly reduces your risk. I had a client in yesterday, or 2 days ago, they were 100% bonds because they don't want any risk in the market. Understood. I understand the market's crazy too. Well, I showed them that if they own 20% stocks and 80% bonds, their return goes up by 0.5% and their risk goes down by 0.5%. So no lose, right? Their return goes up and their risk goes down and they make more money. But now they own 20% stocks. They're kind of fearful of that. But mathematically, that's what works. Consequently, if I'm 100% in stocks by adding 20% in bonds, my return goes up and my risk goes down. Why? Because these things work in opposite directions. Hey, it's great to think everything works in the same direction. You'll love it those years, but you're going to get whipsawed in those years it doesn't work. That's the whole point to diversification. Again, when you pick one of the target date funds in the plan or one of our asset allocation choices, they're doing that automatically for you. Okay? Like that. Because you've got to be diversified between asset classes. Just like the client yesterday that says, I don't want to own international right now. It reduces their risk owning it. Okay? Even though they don't understand why it's in there. Why? Real estate, I try to explain to people we're going to buy some commercial real estate in their accounts. They look at me like, are you kidding me? My house price went down. Commercial real estate is still a good long-term investment. It's actually the best performing investment in long-term in history. It just doesn't always feel right to someone because they attach it to some emotion. But it reduces their risk. So being diversified makes a lot of sense. The other thing I like to mention is asset allocation. Your mix, your model, how your money's positioned, has got a 91.5% predictor of your success. The actual mutual funds you pick or the investments you choose only has got a 4.6% effect. Market timing is only 1.8%, and others only 2%. What does that mean? Make sure you're in the right model for you and rebalance to that. Hey, believe me, I had a client the other day that says, they gave me some money, and said, just decide when to invest the money. Well, that's only got a 1.8% chance. I might as well just get it in there and get it in the model so I know the model works. See what I mean? The odds are at the model. So stay committed to your model even though things get wild. So the first thing you want to do is figure out what your model is. So you're welcome to reach out to me and we can set up a time next time I'm in Bartlesville to do that. To work on the model on the website, of course, to see which model kind of fits where you should be. We can talk about it. That, I think, blows people away when they see 91.5% of my return is due to my mix, not the individual choices I made in the mix. Right? So this is just an example of what's the riskiest thing. Sometimes people want to know, based on the model, what's the most risky investment I can make? What's the most conservative? Well, stability of principal is the least risk. Why? That's like a fixed account, like a CD in a bank, something like that. Why? Because they've got some kind of guarantees built into them. Followed by income, which would be bonds that are paying income, right? Then balanced funds, which are half stocks, half bonds. Large cap value stocks, why? Because they're stable, they pay dividends. Then followed by large cap growth, because they're big companies, they're just growing fast, they've got plenty of capital. Then the small companies, mid-size, and the specialty ones. Global international is the highest risk asset class. Okay? People like to know, it's just kind of interesting to see what's the most risky. You know, I don't know what's going to be the best next year. That's another reason why you're diversified. For example, in 2010, notice it doesn't have 2011 on it yet, but look, small cap stocks were 26% return, followed by large cap at 15, international at 8, intermediate term bonds are at 6.5. Treasury bills were almost 0. But if you look over the years 2000 intermediate term bonds, then small caps, international, national. It's something different every year, guys. So if all your money's in one style of fund, you're missing out on that balance, that diversification. That's kind of the point of what things do when. We don't know. That's why we own a basket. Okay? All right, so what are some other potential benefits from being diversified? Lots of different colored flowers. Other benefits of being diversified is it protects your returns long term. So let's see what the next slide kind of goes into. Here it kind of covers it here. You know, you kind of see the different stock returns over the last years. You know, for example, from 2000 to 2010, the S&P, the large cap stocks only made 0.41%. You all knew that, hardly anything. But look at the small caps, made 5.45. Long-term government bonds made 7.81. You just go down the list and you can kind of see that mix made sense. Now, the 90s, the best were the small cap stocks at 9%, followed by large cap stocks. Again, we don't know what's going to be best. But look over the 30 years, the 80 to 2010. Large cap stocks, 11.36%. But they didn't do anything in the last 10 years, right? Again, we're looking for that blend. You know, the inflation rate for the last 10 years is 241, but the long term is 344. So I don't mean to scare you when I say this, but if your money's in the bank at less than 1% and inflation is 344, you just lost 244 in buying power, right? You don't feel it because you feel like you're safe, but you really lost money. And then you pay tax on the 1% savings if you earn that much too, so you even lost more. Sorry to depress you. Well, that's the worst because people are really overprotected in CDs and money markets right now, and it's to their detriment. So, we'll pass that one. Growth of a dollar. Obviously, the large cap stocks bounce around a lot. Let's keep going here. I've got a lot of slides in there that have a lot of extra stuff in them, but I don't know where you guys are. So both John and Barbara saw their $10,000 investment in common stocks drop to $78.46 in October of '87. So let's follow the story out here. John sold off his stocks and reinvested in 3-month treasuries. As of December of 2010, what happened? Well, his account grew to 20 grand, so he doubled his money over that time frame. So he moved him from a stock, he sold out when things went bad and bought the bonds. Let's look at Barbara. Barbara stayed invested. Look at her account, $66,000. 744% return. It's hard because in 2008, we didn't want to move money out. I don't blame you. People kept calling me and say, I just put in 1,000 and lost 1,500. I just lost all the money I put in. My answer back to him was, technically, you didn't lose all the money you just put in. You lost the money you put in before that. The money you just put in was buying on the way down. Doesn't make you any more comfortable. I'm not saying that. But think about the money you're contributing to when the market's down. You're buying on sale, and you're buying more shares. And when it comes back up, I guarantee you, if you were contributing in 2008, some of those deposits you made have doubled in value now. Those monies helped you make your money back. Warren Buffett loves it when there's a panic. That's when he makes his money, guys. Watch what he's investing in when things are bad. Just watch him. It's amazing. He's making deals with people to get crazy things. All right, so I'm going to pass these slides. I don't want to wear you guys out. Actually, this is a good one. So if you miss the best days in the market, how does that affect your return long term? So from this 30-year period, 1980 to 2010, if I stayed fully invested in the S&P 500, I made 11.36% a year, average. That's great. I mean, I would take that, of course. So my $10,000 grew to $280,000. Isn't that amazing? But if I missed the best 5 months, my return dropped to $935. If I missed the best 10 months, $772. If I missed the best 20 months, my investment dropped to 5%. Look at my return too, by the way, guys. I went from $280,000 all the way down to $45,000 by being out. I never know when it's going to start up again or stop. That's the scary part. But I don't think we're just going to go away and have the money at some point either. Because, you know, I don't have, even if we went to the gold standard and that's all we had, how would you decide how much to pay the guy? He has no way to receive the gold. Am I going to take a little chisel and chisel some off and hand him a chunk? I don't know how that would work. And why could it not be the oil standard, right? Carry on oil, or the diamond standard? It's whatever we value. We just call it gold the value. I'm just making this point as an argument. I want you to think about it rhetorically. It would take a lot. I don't know how we could not have dollars. And maybe it won't be dollars one day. Maybe it'll be Chinese currency. You know, I'm not saying it won't be. But there'll still be some method of trade because, you know what? 100 years ago, 98% of us were farmers. Now only maybe the flip of that. Now we're all mostly city folk. And I couldn't farm. I couldn't last a week because I've got nothing to grow in my city house. You know what I mean? Some of you might. You live out here and there's some space where you can do that. So I couldn't barter or trade or survive without going to Walmart, basically is what I'm trying to tell you. I need Walmart to use dollars to spend there. The other thing I like to hit is don't get caught chasing performance. You know what, it looks great. People will call me and say, why wouldn't I in that fund? It made 15% this last quarter. And I'll say, well, we don't want to move into it now because it's already done that. It doesn't mean it's going to do it again. If we could predict it, that'd be great. But odds are, if you're chasing performance, you get beat. Okay? That's kind of what it talks about a little bit there. Yeah, the key is, with your portfolios, just don't lose sight of your objectives. I started off by saying, I'm not retiring for 25 years. It's true. I don't like it if my 401k drops 35% in 2008, which it did, because I'm very aggressive with it. I'm at 90% plan there. But you know what? It whipsaws back the other way in the last 3 months, too, and I've made a big chunk return back. My horizon's still clear. I'm still committed to my plan. I'm diversified through my allocation. I'm disciplined by continuing to contribute every paycheck and buy in the lows, right, and reduce my average cost. I like to put this one in here because I think people don't know what bears and bulls are. I told you I'd tell you, that's why I would come up with this. So, a bear market, does anyone hear, y'all hear that term on the news sometimes, right? You ever wonder what it was? Probably. A bear market is generally considered to be a decline in the stock market over a period of time. So think about this. The bear is right here. You're not going to get past it. So how are you going to go forward with the market, right? Bears just get up, scare you to death. It's blocked. Versus the bull, a prolonged period of investment prices right. The bull, think about them running through Pamplona and just running down the street. I'm not going to get in front of the bull. I don't know why they do that, but they do. Same thing. So the bulls are running, the bears are scaring. Okay, that's kind of what that means. That's the easy way to remember that. I've seen the bull in New York. Has anyone ever seen it before and gone there? It's pretty cool. Yeah. The other thing I like to point out is recovery from bear to bull. How long does it take? This is kind of amazing. These are all the different declines that were listed on the last slide, what the different were. But the 8/12/82, after 1 month, the market was up 16% after the end of that bear. And after 24 months was up 56%. In 87, 1 month was 9%. So on and so on. Go down the list. Bottom line is the recovery from it's usually a double benefit for most bear to bull recoveries. And that's kind of what we're seeing right now to some extent too. I kind of mentioned dollar cost averaging just a little bit to you guys, which is kind of average pricing through time, investing every pay period. And this is just an example of someone who puts in $100, has $100 to invest. How many shares do they buy? The shares are $10 the first month. The next month they're $5. So it went down in price. So yeah, they've lost money, but they just bought 20 shares instead of 10 shares too, right? And they kind of played that out, so it lowered their average cost over the time. That's kind of the point of that slide. Versus if I would just pay $10 for it, it's now worth $6. If you notice my average price on the other one, or my value is $7.16, I think. So there's a benefit. Okay, any questions? I kind of picked a random topic. Talk about stocks, bonds, mutual funds, some market things, indices. I had a lot more slides, but a lot more graphs, but I silenced them, so I know you guys will want to eat and go back to your places. Yes, ma'am?
Is a stock split positive or negative or good or bad or whatever?
It's neutral. Mathematically, it's neutral. But people, it's considered a positive thing because there's some fear out there that when a stock price gets too high, some people are scared to pay that much for a stock. So when they split it, your stock, you get twice as many stocks, but the price cuts in half. So it's an actual mathematical equivalent. But people like that. For example, some people will be afraid to go buy Apple at $600 a share, $615, because that's very, very expensive, right? So it's going to inhibit a lot of investors of every day to buy any shares because they don't have $615. So there's a mental capacity from being probably $25, $50. They just did psychological studies. That's why they do it. Citibank, if you saw, did a reverse split. They should be the opposite of that. Their stock was $3 and it was embarrassing to them. They did a reverse. They did a 10-for-1 reverse. It went to $30. If you saw that. So you just got, your shares were reduced by a tenth, right, in theory, but your price was the same. They did the opposite of that because their price was so low and they wanted to get some more traction. Because there's some rules out there, some big pensions can't invest in stocks that trade under $5 a share. So there's little middle rules and things out there. It's kind of funny. Other questions? Stocks, bonds, ETFs. We can talk about ETFs today. Mutual funds. Did I cover my time appropriately? It's 12:10, right? Well, thanks for coming. If you have any questions, I'll stick around up front. I've got cards up here if you want to grab one and email me or check back over there. Yes, sir.
I just want to make one comment. If anybody in here does not contribute to this 403B that the school provides, I would really enjoy that. I mean, that's not like I can put in a lot of money. We did lose money for over a year or two, but in the last 3 months, you know, I'm just get excited every time I see that come in. And I've had one, I worked for the state with Mr. Fields for 10 years, and I still have that with Price Fund. So I get comparing the two together. And, you know, just to do it for the fun of it, have a little bit of investment, you know, it's up to $28,000, you know, that I now. Just kind of leave them alone, you don't do anything. You don't want to fun or messing with them, but you still like, we enjoy looking at them and seeing how they fluctuate. So if you don't participate in that, you're really making a mistake because the money that I put in, I mean, it's really got, it paid for over a year of college for travel. You know what I mean? So that it comes to that. So if you don't do that, you really need to look at it because it's not going to cost you that much up front. School's going to match part of it. And really, it's a fun thing. It started out, but it gets up and it's quite a bit of money.
Yeah, it gets serious before long.
It does. It does.
Yeah.
So I think
Great example. Yeah, if you want to know more about that, you can come grab me up and I'll mention talk to you more about my plan. But well, if there's no other questions, I'll let everyone get back to their day. Thanks for coming. Enjoy the last couple of weeks of school.